So overview. So upon completion of this module, you'll be able to develop an understanding of the ways to organize a firm, such as the basic topics of finance, the roles and the structure of firms. And you'll understand the goals of financial management and why financial accounting is so important in our sphere, and identify the agency problem and how to mitigate it. You'll also acquire an understanding of the different verticals of the financial service industries and explore different asset classes and their characteristics. So this is a firm structure or hierarchy. So when you want to start a new business, one decision to make is what to form of the business you want to establish. So you want to determine which income tax you must file and how much liability protection you get in the case of bankruptcy. So there's three business types. There's sole proprietorship, partnership, and cooperation. An extension would be a hybrid form. So sole proprietorship is just one man at the top, kind of dictating everything. Partnership, similarly to the UTIBC structure, where one person, there's two people, and one person's part of one section, such as Thomas being part of logistics and me being part of all of you guys, which is way more fun. And cooperation, corporation, which is just kind of how you see public companies. You have shareholders and it's broken down into a large corp. So yes, moving on to the most common financial statement, the balance sheet. So accounting is a tool for evaluation, right? And the main goal of an investment banker is to evaluate the worth of a company. So there's two things, among others, that we must know in order to evaluate a firm. First, what does the firm own? And second, what does the firm owe? And the balance sheet is one of our main tools for answering such questions. It reports a firm's assets, so what they own, and their liabilities, and what they owe to others, institutions, investors, and such, and the firm's owner's equity. And so that's how much is invested by the stockholders. And the balance sheet is the most well-known of the three financial statements. And we'll be talking about it further in the other slides. And it's fundamental in understanding the value of the firm and how they operate. For instance, we need to know the balance sheet and how we need to know the balance sheet's answer, how a firm has financed projects thus far. Yeah, and so this is the typical layout. So they'll follow, most balance sheets will follow a vertical layout as shown here. And the firm's assets are listed first. I'm pretty sure everyone who's taken kind of any financial course since high school, grade 11, has seen this through and through. So the firm's assets, these are the things, the value of the firm, things that the firm owns. And underneath the assets are the firm's liabilities. So any money that the firm owes to outside parties. And this can range from bonds that the company has issued to utility bills. And the last component is the stockholders' equity, shareholders' equity, which has a few components, but in total is equal, and the total is equal to assets minus liabilities. Yeah. And so we get to the first part, assets. So assets can be divided into two main parts, current and long-term assets. And current assets are assets that are used up or converted to cash within one business cycle, usually very high liquidity. Some examples of this are cash and cash equivalents, such as currency, short-term bills. Others would also be short-term investments, also count as current assets, accounts receivable, and inventory. So account receivables refer to the money that customers owe the company. This may include an allowance for doubtful accounts, as some customers may not pay what they owe. And inventory, self-explanatory again, refers to any goods available for sale, valued at the lower of the cost of market, lowered at the cost of market price. And long-term assets are assets that cannot or will not be liquidated or sold off within the next fiscal year. This includes fixed assets, which include land, machinery, equipment, buildings, and other durables. And generally, these are capital intensive assets. And intangible assets include the non-physical but still valuable assets such as intellectual property and goodwill. And liabilities. So similarly to assets, liabilities are split up into two groups based on their terms. So again, you have current liabilities, which are obligations to other firms that must be paid within the year. This includes things such as short-term debt, accounts payable, and accrued expenses. So some examples of short-term debt could be company-issued bills. Examples of AP is a reverse of accounts receivable, which is essentially the reverse of accounts receivable, would just be maybe a bond, and accrued expenses, and long-term liabilities are obligations that the firm does not have to pay within the year. This includes long-term debt, deferred taxes, and provisions. Okay, shareholders' equity. This is the total amount that would be received by shareholders if the company were to be liquidated, basically sold off. And note that the equity is junior to debt under liquidation, and thus equity is equal to assets minus liabilities, a phrase I'm sure most of you are familiar with. And shares are a portion of ownership in a company. And so under some assumptions, the share price of a company is equal to shareholders' equity divided by the number of outstanding shares, which is fundamental in understanding whether a stock is under or overvalued. And so some of the limitations of a balance sheet, or what it cannot show, is that although a balance sheet does give a good overview of a firm, it doesn't necessarily show the true value of these assets. That is, that some assets are valued on an estimated basis, and debt is often valued at its book value rather than its market value. And furthermore, how can you value an intangible asset like brand name or intellectual property? And internally generated assets are also not included in the balance sheet. And so because of its limitations, that's why we have three more, and we move on to the income statement. So the second of the three financial statements is the income statement. And this is the report that investors pay the most attention to in order to decide which companies they believe have the most growth potential. One thing to remember is that income statements are released according to fiscal years. So income statements are often released every fiscal quarter and at the end of the fiscal year. And accordingly, the figures on income statements are reported for the fiscal period that the statement covers. And generally, okay, so often referred as P&L. So the income statement is commonly referred to P&L, which means profit and loss. And this statement is submitted to the SEC, the Securities and Exchange Commission, which use the profit and loss to determine the financial successes of firms. The income statement reports four main figures. These are the firm's revenue, expenses, gains, and losses. And with these four numbers, investors often summarize the results of the income statement with a single figure, which is net income. And this is calculated with the following equation, which can be interpreted as the sum of the revenues and gains minus its expenses and losses combined. So what's on an income statement? The first element on an income statement is the firm's revenue. Revenue can be broken down into operating revenue and non-operating revenue. So operating revenue is revenue that comes from the firm's primary business. This is what you normally kind of think about when people talk about revenue. Examples of operating revenue include Apple selling iPhones, Microsoft selling Office 365 subscriptions, or Facebook selling user data. However, firms often have other sources of revenue too, which is included in the income statement as non-operating revenues. For example, companies' corporate buildings usually have cafeterias, or at least have cafes in their lobbies. And these stores pay rent to the company whose building they are in. And this counts as non-operating revenue. Other examples of this would be leasing out unused office spaces, advertisement on company property, or royalties from patents. And we get to expenses. Next on the, so these usually can be written off on tax returns and the IRS, and the primary expenses are the inputs of production. Hold on, let me just grab my footing here. Okay, yeah, and the inputs of production and costs incurred by the productions of the firm's goods and services. And secondary expenses are costs that aren't directly due to a firm's everyday activities. And this includes interest on loans on or corporate bonds issued or dividend payouts. And so gains. Gains are usually characterized by one-timeness of a transaction. And this is money made from sales that is non-recurring counts as gains. And most often, the largest sources of gains are sales of a financial asset held by the firm. But gains also include sales of machinery that's no longer being used, or sales of subsidiary companies. The opposite of gains, obviously, is losses. And losses are also non-recurring. One example can be the sale of an asset at a value that is less than what it's bought at for a net loss. And other examples include unnecessary one-time payments that are made by the firm. For example, if, let's say, a firm breaks regulation, their fines count as losses on P&L. And similarly, if a company has to pay out settlements or money from lawsuits, this also counts as a loss on P&L. So everything is considered. So let's interpret what's on an income statement. So we have revenues, expenses, gains, and losses. These are the four main figures posted on the income statement. The main difference between these are the revenues and expenses are recurring, while the gains and losses are just one-time non-recurring transactions. And revenues and expenses can either be primary or secondary, depending on whether they're sourced from the firm's main activity or not. As such, revenues and expenses are often used to measure the performance of a firm in their respective industries. If the revenues are greater than the expenses, it means the front office of the firm who produces and sells the primary goods of the service are making a profit to the firm. And on the other hand, neither gains nor losses come from the firm's production. Instead, gains and losses are usually caused by management of the firm's asset or public image. As such, gains and losses are often used to measure the performance of managers and executives of the firm. So this kind of ties back to in module 1, where we explained basically the stock price does not kind of represent how much capital the firm is making because it's on the secondary market. Rather, it's more internally. And so as such, these gains and losses are used to measure the performance of managers and executives of the firms. And if gains are greater than losses, it means the back office of the firm that manages their assets are making the firm's money. Though it's one thing to note that positive gains are not necessarily a good thing. Gains come from growth of a company's assets, which are often very liquid. And high gains can either mean the money's managers at the firm are very good at their job, but it can also mean that the firm is investing a lot of money in its assets. And in the second case, if a lot of cash is invested in financial assets, it also means the firm is not investing its cash. Therefore, that this firm is making money, large gains can also imply that the future revenue growth may be limited, and the firm may not be the best firm to invest in at this time. So valuations will be after the corporate finance module. So that will be in week 6. So we have event. So this week, not module, when are we starting to value our companies? So essentially, you guys have a portfolio already. Most of the teams should have a kind of a clue what they're going to do for the rest of the year. And after the event and activity, you're going to kind of compile that into maybe 1 or 2 firms and start on your early stock pitch, which is kind of just maybe just like introduction, moats, economic moats, company financials, so and so. And then after valuation, I'll give you guys a template of the DCF model where you can just input your cash flows in, and it'll give you a number out. Yeah. Oh, I didn't finish my interpreting an income statement yet. So there's going to be a lot of ways to interpret a income statement, and it's also very easy to interpret a lot of these numbers in the wrong way. So in previous examples of the gains, it could also be that the firm invested most of its cash in improving future revenues, but their finance team chose very good stocks to invest in, and this made a huge amount. And in this case, large gains on the profit and losses is a very good thing. So it's very important to interpret the P&L in the context of the firm's behaviors and actions, rather than only looking at the firm with the highest net income. And it's important to understand why these revenues, expenses, gains, and losses are the way they are before making a decision on whether a company is a good firm to invest in or not. And finally, we get into the cash flow statement. So a cash flow statement summarizes the amount of cash and cash equivalents entering and leaving a company. A cash flow statement highlights a company's cash management and how well it generates this cash. And this financial statement complements the balance sheet and income statement. And the main components of the cash flow statement are cash from 3 areas: operating activities, investing activities, and financing activities. And the main question a cash flow statement should answer is, where did the cash come from? What is the cash used for? And what was the change in cash balance? And just a note, investors are generally looking for positive cash flow, but if a company sells all of its assets just to get positive cash flow, that's very bad, because they're just boosting up one of their statements, right? So the first one, where does the cash come from? So imagine Oscar's Cookies, which is my company. So where do we get cash? So our main revenue source would be selling the cookies, but we also can issue bonds and stocks. We can sell equipment such as maybe the cookie machine, maybe my whisks, my bowls. We also have interest income and dividends. And we also, Thomas's Cookies also owes Oscar's Cookies $5,000. And what is the cash used for? So it's used for more production of our revenue source, our dividend payment, the repurchase of stock. We can acquire property, plant, and equipment, and we can purchase other businesses. So we can do a vertical integration where we just control the whole supply chain, and we can do repayment of debt. And so, yeah, as mentioned, the components of a cash flow statement are operating activities, investing activities, and financing activities. So cash flow from operating activities is an important benchmark to determine the financial success of a company's core business activities, and is the first section depicted on a cash flow statement, which also includes cash from investing and financing activities. So yeah, this drives income. And on the second one, investing activities, is a section on the cash flow statement that shows the cash generated or spent relating to investment activities. Investment activities include the purchase of physical assets, investment in securities, or the sale of securities or assets. So yeah, acquisitions or capex. And negative cash flow from investing activities might not be a bad sign if management is investing in the long-term health of the company. So as we said before in the income statement, you have to take things holistically. And finally, we have financing activities, which is a section on the cash flow statement, which shows the net flow of cash that is used to fund a company. And financing activities usually include transactions involving debt, equity, and dividends. So you pay debt, pay off debt, pay dividends, you retire stocks, and you issue bonds and new stocks. And debt and equity financing are reflected in the cash flow from the financing section, which varies between different capital structures, dividend policies, or debt terms that the company may have. So if we were, okay, before we get to that part, so this is what you generally see in a cash flow statement. This is kind of the old type where it's vertical, operations, investing, and financing. And I think this is more what generally students are used to, or what we're used to. So you have your operating cash flow, investing cash flow, and financing cash flow, and finally closing cash balance here. And I think this will be very familiar when you start your valuations and your DCF models, as you'll probably do a lot of projections here. So this is what you have, and then you'll project for the future 5 years. So yeah, so let's make connections with all of them. So if we were to sum up each financial statement with one sentence for, let's just say for your interviews, if they ask you, could you name me the 3 financial statements? For the income statement, you can just say it contains revenue and expenses in the given period. For balance sheet, it contains the assets, liabilities, and owner equities at a particular point in time, which is essentially a snapshot of the business financial position on a specific date. And the cash flow statement shows how changes in the balance sheet, accounts, and income affect cash and cash equivalents. And it's categorized into operating, investing, and financing. And so how it's related to the balance sheet and income statement for the cash flow statement is that net cash flow should be equal to between 2 consecutive balance sheets. And for the income statement, cash flow from operating activities start with net income from the income statement. And finally, as a note that I just put here, so you want to compare the operating cash flow with the net income, because if the net income is substantially higher than the cash flow, the company might be accounting for too many accruals, which is net income. And I think we can close this off. So yeah, essentially, this is our financial accounting section. I didn't want to put it too long because you'll have a lot more next sessions, especially with corporate finance, where you'll have your ratios and especially in valuation, where gets a lot more quantitative. But essentially, yeah, that's it. For your sector teams, you're going to be going over your particular company's financial statements. You'll go on either Edgar or CEDAR, depending on if your company is Canadian or American. And you'll be finding the financial statements. And remember to keep in mind everything from this session, as you might see something with a high net income, but you gotta go through everything as a whole. But yeah, thank you everyone. And I'll maybe be seeing you guys in your sector teams. Before the directors leave, could you send me a Zoom link to your sector team so I can just hop in? Because I just need to see. Yeah.
Thank you, Oscar.